Today, I would like us to look at something that is really current, that literally affects not just us on the Ethereum blockchain, but literally affects the entire ecosystem, the entire industry, the entire crypto space. As you all know, because this has been the news throughout the day. So let's start with the Ethereum being approved and officially deemed as a commodity. So far, officially, and also based on regulations, Ethereum has always been deemed unsure, right? There was so much uncertainty around Ethereum. The only clarity that we had up to the last 24, 48 hours was actually Bitcoin. Bitcoin was officially the only commodity among all cryptocurrencies. And as of now, officially, Ethereum is now also officially a commodity. By the SEC approving the form that was filed by the issuers, and it's been approved. That's the first step. There's two forms that have to be approved. The first one has been approved. Bitcoin, prior to its having its spot ETF, it used to also have a futures ETF, and this is why Grayscale was able to win the case in the court, and because of Grayscale's winning, everybody else can now benefit, including Ethereum. So Ethereum is officially a commodity now. It came out of nowhere because nobody literally put it on the map, and the majority of the markets also said so, that it's not going to happen. You know, the SEC is going to at least postpone it, if not just outright cancel it or deny it. But surprise, surprise, we see how things changed drastically, and now officially Ethereum is a commodity. With that said, what does that mean, and what effect does that have now on us as an industry? It's just lately that cryptocurrency is deemed legit, because now with the entrance of institutions, it's now deemed to be legit. Just in January, literally 4 months ago, Bitcoin ETFs were just approved. And this was a major milestone. To this date, it's the most profitable and most successful ETF launch in history. No other ETF or commodity has reached 10 billion assets under management so quickly like Bitcoin did. Literally, it did it within 4 months. Understand that this digital industry is in high demand. It's a new economic monetary system, and it's here to stay. So now, with Ethereum also being in the ranks of Bitcoin, being considered as a commodity, what does that mean to us? What effect does it have for the industry? In contrast to Bitcoin, Ethereum is so much more versatile. What do we mean with that? If you look at Bitcoin ETF, currently what you can do with it is just purchase literally the shares, the ETFs, right? That's literally it. You don't own the real asset. You just own a share, a certificate. And that's it. With that said, it's beneficial for those who aim to own the asset. It's more beneficial for them if they would directly purchase the asset itself. However, because like we always discussed, one of the flaws of Bitcoin, as far as the purchasing it from centralized exchanges, it's extremely illiquid. And that's the issue. So even though the doors are open now for institutions to participate and to be part of this new digital asset, institutions or wealthy individuals still rather go through the ETF route, because it's safer. As far as like reputation, it's regulated. The issuers are the likes of Fidelity, ARK Invest, 21 Shares, BlackRock, and the appointed APs, which is authorized participants, the likes of JP Morgan. Goldman Sachs also came on board, Citibank came on board, and also UBS. So these are all major banks, international banks, that are now also jumping on board and want to participate in this so-called digital gold rush. So with that in mind, if we do comparison, if we now look at Ethereum, it's a much more different asset class because it's more versatile. So what can you do with Ethereum? Ethereum, first of all, it's the largest smart contract blockchain, right? With the most smart contracts and applications on it. That means that you can use Ethereum for the transactions, the smart contract transactions. Without it, you cannot transact. So that's just one of the utilities or use cases. Another thing also is Ethereum is on a proof of stake network, unlike proof of work like Bitcoin is. So this means that you can stake Ethereum. And right now we see how there are multiple different ways that you can use staking. However, if it comes to ETF, the staking part has been left out. And it hasn't been left out because it's considered a security or anything. Because if that would be the case, we wouldn't be sitting here celebrating how Ethereum is a commodity. However, the reason why it's been left out is because the staking part is extremely risky and it's not pro consumer protection due to two things. The first one is because, like we said, in order to stake, you have to be a technical. You have to have 3 softwares running, and you also have to have at least 32 Ethereum. However, those who are able to be validators, meaning those who are able to run those servers, they have the opportunity to be joined. So, for example, if I wanted to stake my Ethereum and I don't have 32 Ethereum, only maybe 2 Ethereum, I can now join one of those servers. The trick here is that I don't know these individuals. They're anonymous. And in order for me to stake, I would have to forfeit my seed phrases. I would literally have to give this individual that I don't know. I don't know where they're from. I don't know their identity. And I'm literally giving them my assets. That's the only way you would be able to stake Ethereum directly. And secondly, it's about the locking, right? The locking period is long. And unstaking period it takes a while. Whenever you want to unstake, it will take a while. Actually, those who first staked 2 years ago, while the transitioning was still in place between proof of work to proof of stake with Ethereum, they were not able to unstake. The unstaking part was just added during the updates and upgrades that were happening on the Ethereum blockchain. So these are the items, and this is the most important part of it. This is the reason why staking as of now has been postponed and is not being considered right now. It's all about consumer protection. Like we said, the locking period is way too long, and this removes access from the investors. They lose control over their assets. They're literally giving it away. And the other thing that also plays a role is that if you want to stake, you literally have to give your seed phrases away, because you're not interacting with a smart contract. You're actually interacting with a human that can make errors, right? And if they do errors, there's a penalty called slashing. So if, for example, this individual's internet goes down and they're not online for a specific period, they get slashed, right? And slashing means you lose all your staked ETH. Not just the individuals that is running that server, but you that are staking with his server. So this is a danger that needs to be regulated and needs to, be looked at more closely. And before that has happened, and there is more clarity and there is more security checks and a safety as far as for the consumer, staking will not be a part in the ETFs, and that's why staking are not allowed right now for the ETFs. Now, this doesn't count for us, because I know now questions are, well, we are having a staking platform as well, so does that affect us too? No, it doesn't affect us at all, because first of all, we have a smart contract. First, our staking is led by a smart contract. You don't have to, with us, we don't have to deal with humans, right? It's a smart contract. And you always have your wallet in your control. And you can stake and unstake whenever you feel comfortable. And this is the major difference, right? You don't have to give access your keys or anything to an individual. All you have to give is access to your tokens, and you can decline it or you can approve it, and you can even determine how many tokens that smart contract should have access to. And this is the difference. So with us, we have a smart contract. We don't literally have an individual that is running a server, and there is no room for error because it's a smart contract on the Ethereum blockchain. It does what it needs to do on the blockchain. It can't error, right? And it can't go offline either, because like we said, it's on the blockchain. The only time it will fail is if the blockchain itself fails, right? This is the major difference. And another thing also, we don't have a lock period. Those who decide to stake on our platform, on the BRL platform, our staking platform, they can stake and unstake at any time. They don't have to deal with locking periods. They don't even have to deal with staking, not staking fees, none of that. This literally sets us apart and makes our staking platform really not have to be affected. Our platform is not affected with the limitations that Ethereum has right now. Because like I said, you need to be a validator, and it's a human being that you have to trust. You have to entrust your keys, your seed phrases, your privacy, and your assets. And this, in the eyes of regulators, is not safe. So, and these regulations that are put in place are strictly for consumer protection, like we discussed in our last community event on Thursday. It's all about consumer protection. And to protect the consumer, you have to have safety and risk management in place. And that's not the case right now for staking Ethereum directly. So I just wanted to clarify that. So now that we've covered the staking part, let's move on to how does it affect us now that Ethereum is a commodity. First of all, Ethereum is a much more attractive asset right now. First of all, it opens more doors. For example, blue chip institutions such as banks, once the regulations go through, they can now offer those services because first of all, they're regulated, they have banking licenses, they have security products, right? But because it's not a security, they can offer products now officially. And because they are trusted, their institutions now can purchase Ethereum directly from these institutions because it's better off for them to purchase Ethereum directly and stake them through these institutions than missing out on the staking distributions when you purchase ETFs. Why is that good for the industry? Because unlike Bitcoin, all the liquidity that would go to Bitcoin on the blockchain is literally going to the ETFs. So all this is going to ETFs. And to date, BlackRock alone has amassed close to 12 billion in inflows has gone into these ETFs in 4 months. That is major. And this is massive. There hasn't been a successful ETF launch such as the Bitcoin ETF. And with this in mind, all the success, the beneficiaries are institutions of the blockchain, right? Specifically BlackRock. They're earning so much in management fees, custodial fees, and this is how they generate revenue, right? They don't care if the price of Bitcoin goes up and down, provided they have enough liquidity for traders to trade Bitcoin through their ETFs, because the way they may generate revenue is through transactions. And if we look at Ethereum will get the liquidity directly on the blockchain because institutions will want to take advantage of the staking. Right now, there are no regulated banks or financial institutions that are offering staking yet. Once that is sealed and done and approved, institutions can now also start offering staking directly. Once that happens, institutions can now purchase the asset directly and have them staked and earn revenue that way. That's the difference between Bitcoin and Ethereum, is that liquidity is not limited to ETFs alone, but now liquidity will be coming to the blockchain directly. And this is the major difference. And this is actually the most important thing, because now when we hear that hundreds of millions of dollars in Bitcoin have been purchased, we don't see that in the price. It doesn't affect Bitcoin price directly, right? Because they're purchasing all these Bitcoin over the counter through Coinbase. Institutions are. The only time we see reflections, the price reflections, if when retailers purchase Bitcoin over centralized exchanges. And this is now the biggest difference between Bitcoin ETFs and Ethereum ETFs, is that due to the missing piece, which is staking for ETF holders, they'll be missing out, and no one wants to spend hundreds of millions in Ethereum and they can't stake that, right? Nobody wants that. Like, it's not good business. So those that opt to purchase hundreds of millions in Ethereum, obviously they would want to have them staked, because right now the current APR for staking ETH is roughly 5%. So if we do the math here and say, for example, an institution purchases 100 million worth of Ethereum, 5% of that is 5 million, and that's for the year. So I doubt that an institution will decide to leave out $5 million a year in extra revenue and also decide to pay fees for having their assets managed and then pay custodial fees as well to have the assets in custody and also pay management fees, right? So this all chips away from your revenue. In contrast to Bitcoin, you don't even have that option because the market is not liquid enough for you to literally transact efficiently. But with Ethereum, we'll see how due to this component, staking component, it will allow institutions to provide heavier liquidity into the open market. And this is the major difference now. And this is where we might also see an opportunity for Ethereum eventually to flip Bitcoin, not immediately, but in the mid to long term, simply because this difference. Another thing that makes Ethereum so attractive is because it's deflationary. The more transactions that Ethereum has, the more deflationary it gets. And with our current financial system, we're so used with inflation, and we often really underappreciate an asset that is literally deflationary. And as we speak, there is no commodity currently right now on the market that is deflationary, literally, because Bitcoin is not deflationary. Bitcoin is inflationary. But now, with Ethereum being the second commodity now, officially, it makes Ethereum the very first commodity that is deflationary, literally. And this has never happened before. There is no deflationary asset right now. This is another thing that sets Ethereum completely apart and puts it on a whole different level. Because, like we said, there's a chart that we always look at. And that chart shows how various companies, led by Microsoft, and then we saw Google, we saw Apple, we saw Tesla, how long it took them to hit the $1 trillion market cap. And we saw that it took Microsoft 44 years to hit 1 trillion market cap, but it only took Bitcoin 12 years to hit that 1 trillion market cap. And unlike Bitcoin, these institutions are based on production, right? They have to produce, whether if it's software, logistics, whether it's like Apple is into production, like the tablets, smartphones, smart watches, all these various things, right? They have to produce. So it's about producing. That's what it's all about. So the more they produce, the more the output, the more the sales they'll have. But Bitcoin is not like that. And not just Bitcoin, the industry, crypto industry overall is not like that. It's strictly based on adaptation. The way it works is the more the industry adopts a specific ecosystem or a specific cryptocurrency, that's how it grows. Why am I mentioning this? It's because the way I mentioned, Ethereum is deflationary. That means the more Ethereum is being adopted, the more transactions obviously will be occurring. And the more transactions, that means the more deflationary Ethereum will be. And this, as we know, if you have an asset, which is a commodity, that is being adopted, and as the more adaptation it gets, the more deflationary it becomes. So imagine if Bitcoin that is inflationary, it took Bitcoin 12 years to hit 1 trillion. So Ethereum, as it's being officially a commodity now and being embraced by institutions on top of retailers, it's going to hit that market cap even faster now. Because keep in mind, Ethereum didn't come out till 2015. So it came out like 6 years after Bitcoin came. So let's see how this will play out. But if an inflationary asset such as Bitcoin was able to hit $1 trillion market cap within 12 years, let's see how much faster a deflationary asset is going to achieve that. Besides, you have Ethereum that also has staking that is locking away supply, right? Now, keep in mind, the difference also between Ethereum and Bitcoin is that Bitcoin has a limited supply of 21 million. However, Ethereum is unlimited. So it really has that currency mechanism because it has an unlimited supply. Nonetheless, the more it's adopted, the more transactions are taking place, it makes it deflationary. And it's been actually draining its total supply. So it's been decreasing in total supply. And that's the whole idea. So these are the differences that I just wanted to highlight. And I also wanted to just showcase that this is what sets Ethereum apart from Bitcoin. Bitcoin is just looked at as a store of value, but we all understand that it doesn't officially qualify as one, because in order to be a store of value, you need to have liquidity, meaning that whenever the holder of that currency, specifically Bitcoin, wants to cash out, they should be able to do so. That's really what qualifies an asset, a cryptocurrency, officially to be a store of value. And this has been an issue not just by cryptocurrencies, but this has been an issue in the financial industry as a whole. And this is the reason why also we see how Circle, its aim is to become the first full reserve digital bank in the US. Nothing happens by chance. Everything is literally calculated. Everything that we look at is not by chance. There is no coincidence. Let me make an example. In order to be a stablecoin issuer, you have to have a banking license. This is now one of the requirements. This already will take place in Europe next month by the end of June. In order to be stablecoin issuer in Europe, you have to have the MiCA license. If you don't have it, you won't be able to issue out Euro stablecoins. And if you are US dollar stablecoin issuer or any other currency, you are limited to a certain amount and you can't go beyond that. So you see how regulations are starting to really pile up, and this is good now, because now that institutions are starting to come in, and these institutions obviously rely on retailers, and retailers are the main revenue drivers for these institutions, and this is the reason why these retailers need to be protected, and this is why regulations are coming in. Often when we hear regulations, we get turned off, we become standoffish. There is always pros and cons in things. However, as far as regulations, they will literally bring more protection for the consumer. Specifically now, in this case, that the regulators are literally reluctant to offer the staking for ETFs due to those two things that we mentioned, that you have to literally give away your keys, your seed phrases. That's a no-go, because what we always preach is not your keys, not your assets, right? That's something you never give out, no matter what. That's only for your eyes only. You have to be your own bank. Your wallet is literally your account, and you have to protect it. You have to protect those keys and don't share it with anyone. And that's the whole idea of the cryptocurrency in the first place anyway.